This is an NBC News special report.
Tonight, the CDC sounding the alarm on the Delta variant and the risk even to fully vaccinated Americans. The CDC warning in internal documents the war has changed, citing evidence vaccinated people can suffer rare breakthrough infections and may spread the Delta variant as easily as the unvaccinated. Delta also believed to cause more severe illness. The pivotal discovery, a major cluster with a staggering 3 in 4 infections in vaccinated people. And what NBC News has found, at least 125,000 breakthrough infections in the U.S. What you need to know. Vaccinated people can suffer rare breakthrough infections and may spread the Delta variant as easily as the unvaccinated.
All right, today is Sunday, August 22nd. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, and I know I say this every night, but this one is extra special. Why is it extra special? The reason is we're going to have a massive move, a big one, coming imminently in the market, and it might not be in the direction that you think it will be. Why would the market move in an impulsive fashion? The reason is, here it is. In focus tonight, what else? Delta, the big D. And folks, remember what I said in the last video with the Kashkari in the thumbnail saying we're not going to taper under any circumstances. If you did not watch that video, you must watch it. And the reason is, I explained to you why bad news is actually good news for the market. In a nutshell, the market has been a Coke addict. What is the Coke? The Coke is the monetary liquidity, aka the quantitative easing out of the Federal Reserve. The market has been moving higher solely based on the cocaine alone. No fundamentals, no rationale at all. So the market cares not about nuclear wars, civil wars, asteroids hitting the planet, pandemics, cases rising higher, fatalities rising higher, hospitalization rising higher. That doesn't matter to the market at all. What matters to the market is one thing, the cocaine. And if the cocaine gets interrupted, then the market will suffer withdrawal. Therefore, everything you hear, every piece of news you see, you have to ask your question. You have to ask the question, how does this piece of news impact the flow of the cocaine out of the Fed to the market? Well, if we have good news after good news after good news and the economy continues to recover and inflation rises higher, then this will impact the market negatively because the Fed will have to cut the cocaine. Otherwise, inflation will rise out of control. But what if we have bad news? Then the Fed will have the excuse to continue the flow of cocaine to the market. And this is exactly what the Fed and market bulls have been cheering for. Delta, Delta, Delta. Please kill more people so our stocks can move higher again. Our stocks been doing nothing for months and months and months. We need to make some cash here. We need to make the rich richer and move these stocks higher. And of course, the prayers of the Fed and their allies have been answered. And now Delta is becoming a major problem, not due to the rise of cases, by the way, or fatalities or hospitalization, but due to the economic impact of Delta. If people are scared and they change their spending behavior, then the economy will be impacted negatively. Likewise, if we have shutdowns around the globe due to Delta, then we have an economic problem. And therefore, now the market cares. Why does it care? It cares because Delta is becoming an economic problem, not just a healthcare problem. And if it is a problem, this is bad news, which means good news for the market because the flow of Coke will go on and on and on. What does that mean? I know what you're going to say. We put our blindfolds on, we run Naruto style, heads first, ask questions later, and we buy stocks, we buy calls, all in. Hold your horses on that one for a little while, because we're going to talk about this in details and why the reaction this time could be different. It could be that the market will crash. We'll talk, but let's go over the facts regarding Delta. As you can see, cases are rising in the United States, not the United States that you built in your little PC game. This is the United States. Cases are rising significantly higher. And this wave that we're going through right now is larger than the initial wave that we got in 2020, even though back then we had zero vaccination. Okay. What about the number of fatalities in the United States? Rising, but still muted, still under control, still not a problem that merits lockdowns. So far, so good. We don't have bad news economically from the rise of Delta, at least looking at this piece of data alone. Now, when we look under the hood for specific states, say Texas, for example, this wave, the Delta wave, is larger than the first wave, and it's about to surpass the second wave, which happens to be the largest wave, causing all of that chaos and fatalities in the United States. Matter of fact, the number of fatalities in Texas also rising higher. What about Florida? The Delta wave is the biggest wave of the COVID-19 virus in Florida. It has surpassed the first and the second waves. Yet the number of fatalities in Florida, it rose higher, but it looks like it has peaked and now it is trending downward. Okay, so far, so good here. Because if we have more fatalities, then we're going to start talking about lockdowns. But if the number of fatalities is still under control, and the assumption is this is the impact of vaccination, preventing the number of fatalities from rising higher, unlike the first and the second waves. Now, let's look at leading indicators, in this case, Israel, because Israel is a highly vaccinated country. Well, cases are rising higher, and this third wave, the Delta wave, is as big as the first and the second wave, even though in the previous two waves, Israel did not have a high record of vaccinations. Matter of fact, vaccines were not even available back then. What about the number of fatalities in Israel? Also rising, but still under control, below the first and the second wave. We'll see what happens from here on. What about the UK? Another leading indicator. Cases went down, but I told you COVID looks like it's buying the dip here. And indeed, it bought the dip, and cases are rising again in the UK. The silver lining is that fatalities are not rising in the United Kingdom, and that gives us a sigh of relief that we might see cases rising here in the United States, but all in all, the number of fatalities will not be as bad as the first and the second waves. This is the assumption. We have to wait and see. Here's where it gets a little complicated, by the way, when we talk about Delta becoming an economic problem. Here is the number of cases in Vietnam. Vietnam did not have a first or second wave. Matter of fact, the country did not even have a COVID-19 problem last year at all. And now cases are surging higher in Vietnam. Not just cases, but also the number of fatalities. Why is this important? Because Vietnam is an important economic hub from which we import a lot of goods. All of these Nike shoes, they come out of Vietnam. Well, if we have a shutdown, an economic shutdown in the ports in Vietnam due to Delta cases rising, you combine that with the shutdowns of ports in China and the shutdowns of entire cities and regions in China. Now Delta becomes an economic problem. So far, so good for the market, because this is bad news. Economic shutdowns, this is bad. But remember, bad news is good news for the market due to the flow of coke. More facts. The number of hospitalization is rising significantly higher, specifically in unvaccinated states. The likes of Alabama, Mississippi, Wyoming, Louisiana, Arkansas. Underline Wyoming. This is where Jackson Hole is. We'll talk about Jackson Hole in a minute. But likewise, cases are also rising among the vaccinated. We're getting the data from Israel, where there is no bullshit in hiding facts and politicization of facts. And Israel has one of the world's highest daily COVID-19 infection rates, despite high vaccine uptake. And now we're hearing more and more about breakthrough cases. In Los Angeles, breakthrough infections are now 30% of all new COVID cases amid Delta surge. National Geographic says evidence mounts that people with breakthrough infections can spread Delta easily. A new study finds that the dominant variant can grow in the noses of vaccinated people as strongly as in unvaccinated people. Now, I'm not a scientist, I'm just a douchebag on YouTube, but I told you this from the get-go, and I've been right so far. These mRNA vaccines will give you antibodies, meaning that if you get infected with COVID, the antibodies are already in you, and they will fight right away and prevent severe illness. Otherwise, you're going to have to go through the process. Your body becomes ill, and it has to initiate a reaction to produce its own antibodies. Some people have weaker immune systems, and they cannot survive the fight. On the other hand, these mRNA vaccines have the so-called Snapchat effect, where they last for a little while and then they disappear. Now, there is no way for you to verify whether the antibodies that you have are still active or they disappeared. You have no clue. Everybody reacts differently, and therefore, if somebody had the Snapchat effect and the antibodies are gone, even though they're vaccinated, they're going to get infected just as an unvaccinated person would, and they're going to spread the virus just as an unvaccinated person would. Makes sense. Simple logic from a douchebag on YouTube. And of course, don't expect any transparency from your deal leaders in the government or the media. The CDC only tracks a fraction of breakthrough COVID-19 infections, even as cases surge. The CDC says this is a pandemic of the unvaccinated, but the reality says that this is a pandemic of the vaccinated and the unvaccinated alike, even though the vaccinated have a little better shot here of surviving severe illness. And the reason is, and we now know, finally, I've been telling you in this program over and over and over again, the data from Israel and the United Kingdom suggests that vaccine efficacy dwindles over time. The Washington Post described us as vaccine deniers with weird obsession about Israel. Well, turns out that the data out of Israel is 100% right, because we now have a confirmation the vaccines indeed lose efficacy after time. And now we have the President of the United States, Biden, who gave a televised speech live on air indicating that in September we're going to have another booster shot. And of course, all of this is confusing everybody, the vaccinated, the unvaccinated alike. Everybody's confused here. What's going on? What is the truth? What are the facts? What's going on here? We have a lack of clarity, and the reason is the issue has been politicized by the government and by the media. They decided to forego facts, rationale, transparency, and decided to go 100% propaganda. The problem is, and this is where it gets more into the economic side, while we might have a sigh of relief here that perhaps more booster shots will defeat Delta and future mutations of the COVID-19 virus, and we can go back to normal again. Here's the problem. This is from the Times of Israel. 14 Israelis have caught COVID-19 despite receiving booster shot. And if we continue to get this news, even after the booster shots are initiated here in the US, then we're going to have a problem, because at what point does this nightmare end? And I highly recommend for you to read this article from Nature magazine. The title says, "The mutation that helps Delta spread like wildfire." In it, they explain in details, scientifically, why this virus remains stubborn and it continues to mutate and becomes even more infectious as time goes by. Now, so far, we've been talking about bad news. And remember, bad news equals good news for the market. But here comes the good news, if you can call it that. On Monday, the FDA is expected to grant full approval to the Pfizer-BioNTech coronavirus vaccine. The thinking is that once the FDA approves the vaccine from Pfizer, we will remove some of that vaccine hesitancy and more people will become vaccinated. The problem is, what if those vaccines, those boosters, also lose efficacy over time and the virus doesn't stop you mutating and creating even more infectious and more dangerous variants? Of course, the FDA is approving Pfizer's vaccine, but not Moderna. It will take a little longer for Moderna's vaccine to be approved, and the reason is, here's from the Washington Post, U.S. review of possible link between Moderna vaccine and uncommon side effect delays adolescent approval. So there is a side effect here, specifically among younger people, and it is related to heart disease. You can read the article and get the details for yourself. But this is what's delaying the approval of Moderna's vaccine. Now, remember this, Moderna's vaccine is more effective than Pfizer's, at least from the data we have so far. Over time, both vaccines lose efficacy, but Pfizer's loses more than Moderna's. Enough with the good news, and let's go back to bad news. You know, the spicy stuff that you people wait for. Why? Because it's good for stocks. 3 U.S. senators test positive for coronavirus. These are all vaccinated senators, and they got infected with the virus anyways. You have to remember this. It is also a battle of psychology in the market. It's not just weighing in bad news and good news. There is the possibility, and I'm leading you, by the way, to the beginning of my statement, that perhaps the reaction of the market will be what you don't expect, aka crash. Why? Because you factor in the psychology, and there is the possibility of a panic reaction in the market. And this kind of news makes that reaction more likely. Remember, in the initial wave of the COVID-19 crisis last year, the reaction of the market was panic, and we saw a crash right away. And then the market realized, wait a minute here. Our main concern before the coronavirus crisis was the pace of economic growth is accelerating way beyond expectations, and inflation is starting to show up in the economy, prompting the revisit of monetary tightening by the Fed. They tried to do it in 18 and the market crashed right away. They reversed course, and the reason was back then we have a lot of uncertainty regarding the trade war, etc., etc. But in 2019 and in January and February 2020, we were already past the trade war. We had an agreement, so the main worry for the market was the Fed will go back to raising interest rates and tightening. But when the COVID-19 crisis hit, the market had the initial reaction of panicking, and we saw the crash right away. But then the market realized that this is perhaps the best thing that ever happened to the stock market, the COVID-19 crisis, that is, because it will prompt the Fed to forego raising interest rates and tightening altogether. Matter of fact, the Fed will usher the so-called bazooka, the nuclear weapon of flooding the market with even more coke than ever. And right away we saw the V-shaped recovery and then some in the market, the largest, most insane rise in the stock market in history, the biggest bubble, the biggest orgy in history. But you have to remember that at some point the market will hit panic mode once again, and we will see these sharp crashes. I don't want to get too technical on you here, but a panic crash this time around will be accompanied with a lot of margin calls because the majority of buying has been gambling via margin. And when margin calls hit, you will see double-digit crashes in the market instantly. We'll talk more in the charts analysis. Back to Delta. We're moving now from cases rising higher to the vaccine efficacy being under question to perhaps we're getting more panicky now, leading, there it is, lockdowns, perhaps. And this is where the problems start for the market. On paper, this is bad news, which will equal good news for the market, but you have to factor in the panic scenario. Your assumption is if we have more lockdowns, this will be good for the stock market. But what if we have the panic situation? Always keep that in mind. And of course, when there is panic, when there is uncertainty, when in doubt, always issue a new stimmy. Questions are now rising. Are we going to have a fourth stimulus check? Hundreds of thousands of Americans have signed a petition calling for $2,000 monthly stimulus checks in the wake of the Delta variant. Let the cat be out of the bag already. We're gonna do UBI sooner or later. So let's do it right now and give everybody $2,000 a month forever and ever and ever. Why is this important? More stimmies will mean higher inflation. Keep that in mind. We're going back to square one. Every progress we've made year to date is gone. And now we're going back to square one. We need more vaccines. We need more Fed stimulus. We need more fiscal stimulus. On paper, this is good for the market. But at what point do we get to the straw that breaks the camel's back? And we reach a panic situation. This is not transitory, the crisis that is, and it will prolong with us for a long time, longer than we expected, and this will cause a severe scarring on the economy for years and years to come. There is a point, there is an inflection point where bad news become bad news again. Keep that thought in mind. We'll talk about it in a second. But before we do that, perhaps this is the most important news out of all of this Delta talk. All eyes were in Jackson Hole this upcoming week. We were anticipating the Fed to announce tapering in October, and the decision will be taken in the Jackson Hole meeting. The cabal of central banks gathers every year in Jackson Hole, and they do their satanic rituals, and they decide what to do with our future. And the fear this time around was that the Fed will start tightening its policy. And is there a better place, by the way, to hold these meetings besides Jackson Hole, which has the largest wealth gap in the United States? It is symbolic, after all, to what the Fed has been doing to our economy by engineering and widening the wealth gap bigger than ever before. So we were heading into the Jackson Hole meeting worried that perhaps the Fed will announce tightening of the monetary policy, and God forbid our stocks that have been up over 100% year to date, perhaps they'll go down a little bit. And in this mania, in this orgy of a bubble, God forbid stocks go down. We cannot even handle a red day, a red candle intraday. We cannot even handle that. But then this happened.
Welcome back. We've got some breaking news on the Fed. Steve Leisman joins us now with that. Steve, what can you tell us?
Well, if our understanding is the Kansas City Fed is canceling the in-person portion of Jackson Hole, the conference, citing COVID-19 and health concerns. They're going to hold the conference virtually on Friday. This is a big disappointment, Will, for a lot of people who are planning to go, and also I think interestingly symbolic economically of concerns about the resurgence of COVID-19.
Okay, so the Jackson Hole meeting is off the table now. They're going to do it virtually. This is extremely symbolic to what the Fed is about to do. The initial worry was that the Fed is about to tighten the monetary policy. But if the Fed itself cancels its meeting in Jackson Hole, then perhaps tapering will not happen after all. Because, say it with me, Delta. We have uncertainty. We have cases rising. We cannot taper right now. We got to keep the charade and the coke going on for a little while. But perhaps even more important than canceling the Jackson Hole meeting is the flip-flop from the king of hoax, Dallas Fed President Bob Kaplan, who's been spearheading the position that the Fed has to taper now. And inflation is rising out of control, and inflation will not be transitory, as Powell says. Kaplan, aka the chairman, we call him the chairman because he likes chairs. Kaplan says he may rethink his call for taper to start in October if Delta variant slows down the economy. Pay attention now. Kaplan rejects the Fed chairman Jerome Powell's description that rising prices are transitory, so he still believes that the amount of coke that was spent in the money supply will result in inflation sooner or later. But for now, if Delta slows down the economy, and I will show you that Delta indeed is slowing down the economy, then perhaps tapering should not happen. Tightening should not happen, and the Fed should remain accommodative for now. So far, so good for the market. Here's the problem, and here's perhaps what will cause the panic scenario in the market. Delta surge dampens Americans' appetite to go out. And you can see the moment the CDC mandated masks once again, spending in retail stores, grocery stores, restaurants, gyms went down significantly. It was trending higher to the tune of 20% over the levels of 2019, meaning the economy was growing higher and better than 2019 pre-pandemic, and therefore inflation expectations were rising significantly higher. But now, in an instant, the activities of spending in retail, grocery stores, restaurants, and gyms went down to the tune of 60% down from the levels of 2019, indicating that the consumer is responding negatively to the rise in Delta cases and the Delta problem overall. The $1,000,000 question is, will the market respond to this news as it did before? Bad news is good news because the Fed will keep the coke being injected in the market every single month? Or will it be the inflection point from which the market will realize that bad news is actually bad news? We will see. Now, I'm not a seer. I'm not the Messiah, but I will do a scenario analysis for you here. I cannot tell you whether the market will respond positively, negatively, panic situation. I cannot predict that for you. What I can do is doing a scenario analysis of what will happen in response to the cancellation of the Jackson Hole meeting and perhaps delaying tapering, pushing the can down the road The leading indicators would be the US dollar and yields. The dollar is represented by the dollar symbol. Surprise, surprise. Yields are represented by the bank symbol, the Fed symbol in blue, and then we have to study the impact on different class of assets. You have oil, and then we have commodities represented by the grain symbol, and then we have gold, we have the inflationary stocks, financials, energy, industrials, materials, and then we have tech and growth stocks. The first scenario to study is, what if the Dixie goes higher along with yields? What if the market interprets the delaying of tapering and cancellation of Jackson Hole as a green light for inflation to continue to rise higher, therefore yields rising higher? But also this will be accompanied by a rise in the US dollar regardless of the cancellation of tapering due to the rush to safety from foreign investors. It is a rare combination. It is unlikely, but it will happen if the market interprets the cancellation of Jackson Hole and delaying tapering as a green light for inflation to rise higher, but also a green light for the rush to safety in the United States dollar. It's a rare combination because if investors rush to the safety of the US dollar, then the assumption is they will rush to the safety of the US bonds, and therefore yields go down. But we have to study the scenario anyways, because the market has been weird all along. In this scenario, the dollar rising higher, is this good for oil or is it bad for oil? The answer is it's bad for oil, and therefore we have the negative sign. What about commodities? The rise of the US dollar is bad for commodities across the board, but perhaps the rise of yields is an indicator of increasing inflation or allowing inflation to rise higher, and therefore we're using the divide sign to indicate that this is neutral. Some commodities could go higher, others will go down. For example, gold. Remember, gold has three enemies, but two major ones, the US dollar and yields. Well, if they rise both together higher, then gold will get whacked severely. Gold will crash. What about the inflationary stocks? Well, if the US dollar is rising higher, ask yourself a question. Is this good for industrials with overseas revenues and profits? Is it good for energy stocks reliant on crude oil prices? Is it good for material stocks who's also reliant on the US dollar in the commodities market? The answer is it's bad. When the US dollar rises higher, this is bad for the inflationary trade. On the other hand, the rise of yields could be good for financials, and therefore we say it is all in all, this scenario is bad for inflationary stocks, but it could be good for financials. What about tech and growth? We have solid evidence that the rise in yields is bad for the Nasdaq. There is an inverse correlation between yields and the Nasdaq. Likewise, the rise of the US dollar is bad for stocks in general. So perhaps maybe big cap stocks could weather the storm here as investors rush for quote-unquote safety in Apple, Microsoft, etc. But all in all, this will be bad for the tech and growth sector of the market. What about the second scenario of the US dollar rising higher but yields going down? This is what's been happening for the last few months, for the last few weeks. The Dixie has been popping higher. Meanwhile, yields have been crashing. This was bad for oil, bad for commodities, neutral for gold. Gold has been trading sideways, not doing anything at all under these circumstances. Now, what about the inflationary stocks? In the last 3 months, since the Dixie started to rise higher and yields started to trend down, was the inflationary trade leading the market? Of course not. The inflationary trade was crashing, and therefore this scenario, if it continues, it is bad for inflationary stocks. What about growth, momentum, tech? Well, we saw a rebound in software names, in big cap technology names, in the growth and momentum names under this circumstance, when the dollar goes higher and yields go down. So the assumption is, if we continue in this scenario, then the favorable sector of the market will be tech, growth, and momentum. What about the third scenario? If the Dixie goes down but yields pop higher, this is the exact circumstance, this is the exact scenario that happened earlier in the year, at least in the first quarter. This has been good for oil. Crude oil prices surged higher under this scenario. Likewise, commodities surged higher under this scenario, from lumber to grains to metals to meats, all rising higher. When it comes to gold, again, gold has two enemies. One enemy is down, the US dollar. Another is trading higher, yields. And we saw that the performance of gold in the first quarter was pretty much all over the place, slightly negative, and therefore we will say it is neutral. What about the inflationary stocks? This is a no-brainer. In the first quarter of the year, the inflationary stocks, value stocks, outperformed significantly, and therefore this is a positive scenario for the inflationary stocks. Now, why would this scenario happen, by the way? If tapering goes off the table, then the Dixie will trade down because the Fed will continue to inject coke in the market, and tapering will be unforeseeable, at least in the near term. Why would yields rise higher, though? Perhaps the Fed not tapering will allow inflation and the pace of growth to continue to rise, and therefore we go back to the same scenario we had in the first quarter. I doubt it, but it could happen, and if it happens, it will be bad for the tech and growth sectors of the market. These are the names that crashed and underperformed in the first quarter of the year when we had this exact scenario of the Dixie trading down while yields trading higher. Lastly, what about the fourth scenario, where the Dixie goes down and yields also trend down? Think about it for a moment. Oil, the price of crude oil, cares about the US dollar trending down. So this is a positive catalyst for oil prices to rise higher. What about the decline in yields, though? Perhaps this is an indicator of the slowdown in the growth and the recovery in the economy. If that is the case, then we're not going to see the supply of oil rising higher, which will mean that OPEC will have full control over the price of oil, and therefore this is a positive catalyst for oil to rise higher. What about commodities? If the US dollar goes down, this is a positive catalyst, a tailwind for commodities to rise higher. But if yields go down, indicating that the pace of economic growth is also slowing down, then perhaps we will see a mixed picture in the commodities market. Perhaps grains will go down, meats will go down, softs will go down, with exception of lumber, for example, and oil, as we said, trading higher. So it is a mixed bag when it comes to commodities. What about gold? What happened to gold when both enemies go down? This is a fantastic scenario for gold to rise higher. What about the inflationary stocks, financials, industrials, metals, etc.? When the US dollar goes down, this is a positive catalyst for energy stocks, industrials, and materials. But perhaps it is bad for financials, and the reason is when yields go down, this will be a negative catalyst for financials. They depend on higher yields. They depend on the yield curve being steep. If the yield curve flattens, this is not good for financial stocks. So all in all, positive for the inflationary trade, but negative for financials. Lastly, what about tech and growth? When the dollar goes down, this is positive for all stocks, specifically multinational stocks that make a lot of revenue, lots of profits from overseas, and they have the currency impact where you have a lower US dollar, so that amplifies your overseas earnings. This is good, specifically for the large technology companies, the likes of Apple, Microsoft, Google, etc. What about yields going down? We talked about this. The Nasdaq and yields have an inverse correlation. If yields go down, then the assumption is the Nasdaq will pop higher. So, all in all, again, I'm not the messiah. Please do your own homework. Remove all of these symbols that I have, the positive, negative, and neutral, and fill this one on your own. And see if you get the same results as I am or not. And let me know in the comments, by the way. But let's talk here. What is the most likely scenario to happen now that the Jackson Hole meeting is canceled? Oh, and by the way, Delta is becoming a problem, so much as it will merit delaying tapering and tightening of the monetary policy. If that is the case, what is the likely scenario here? The assumption is delaying tapering will push the United States dollar down. And the market, of course, threw a fit. We're talking about the bond market here. When the Fed announced perhaps that tapering will happen this year. From that point, Treasury yields have been trading down. So the most likely outcome, the no-brainer outcome is Dixie goes down, yields go higher. And therefore, this will be good for crude, good for commodities, good for inflationary stocks, and even gold. Perhaps gold will go higher, but not good for tech and momentum. But be careful what your assumptions are. What if this is indeed the straw that will break the camel's back. We will see a panic scenario in the market. A panic scenario will push the US dollar higher. Remember the rush to safety, which includes buying the dollar and buying bonds, meaning the Dixie goes higher, yields go down. This is the second scenario, which will be negative for the entirety of the market with exception of tech and growth. Again, I'm not a seer. I'm doing my best here to study each scenario and be 100% prepared to whatever scenario that could happen in the market. The rational and reasonable behavior right now, at least for me, was to take profits off the table. And therefore, in the last couple of weeks, I have sold about 50% of my portfolio, raising cash and becoming ready for the worst case scenario. But let me know in the comments which scenario you think is more likely now that the Jackson Hole meeting is canceled and tapering is delayed. Oh, and by the way, how would each class of assets react? Do you agree with me, my analysis, or do you disagree? Let me know in the comments. Now, let's move on to the regular market coverage, but we're going to skip the options coverage, futures, etc. And the reason is, honestly, there were no interesting trades in the options market, no significant trades whatsoever. What I can tell you is, a little birdie told me that the institutionals are buying Viacom, specifically calls on Viacom. This is the same birdie that told me earlier in the year that the same institutionals were buying Google. And we know that Google was and still is the overperformer among the FANG stocks. Now, are they going to be right or wrong? Who knows? But it is worth it to buy some Viacom calls and see what happens. And if you lose it, you're going to lose the premiums on the options, and that's about it. I want to go over the heat map, the weekly heat map that is, briefly, because we have some parallels between this one and the pre-COVID crash of last year. This is the weekly heat map, and of course, the inflationary trade is not performing at all. Financials, energy, industrials, materials, all getting whacked, along with the cyclicals and chips, with exception of Nvidia. The obvious outperformer is the healthcare sector of the market, in addition to Netflix, which saw a gamma squeeze, and Microsoft, a stock that I own in my portfolio. And by the way, on Friday, I sold half of my position in Microsoft. This is unrealistic for the stock to move this high. It is a large position, and I sold half of it on Friday. Now, do me a favor, please, because I cannot do everything for you. You have to do your own homework. Go back to the pre-COVID crash. Which stock was leading the market impulsively higher in the weeks prior to the COVID crash? The answer is Microsoft. I remember because I owned the stock back then, and it was unrealistic back then, and it is unrealistic right now. It's an interesting parallel here that Microsoft led the market pre the crash, and now it is leading the market as we start to enter a highly volatile season of the market. Is there any significance here, or am I just being superstitious? We'll see. Another outperformer this week is Kroger, the ticker KR, which happens to be another stock that I own in my portfolio. And it is my largest holding, by the way. I made a video on this stock over a year ago, describing the stock as the safest stock to be in. And the stock indeed delivered in high volatile times in the market, when there is uncertainty, when there is yo-yoing back and forth between inflation, disinflation. Kroger continues to outperform regardless. Here's another outperformer for the week, the ticker LOW, Lowe's. We got the data regarding consumer spending, and consumer spending cratered when it came to home improvement, stores, gardening, etc. We saw Home Depot crashing earlier in the week. Shorts assumed that Lowe's earnings will come out disappointing based on that data, and they shorted the stock ahead of time. Guess what? Lowe's released earnings, and earnings did not disappoint. It was a surprise to the upside, actually, and therefore all of these shorts were forced to cover aggressively. Perhaps the negative data regarding home improvement stores will show up in the next quarter, not this quarter. So the shorts jumped the gun here. They got whacked. Another outperformer this week is the ticker TJX for TJ Maxx, rising higher by the tune of about 5% for the week. also on the heels of earnings, by the way. Here's another name that managed to outperform this week, the ticker ROL, Rollins. This is a great play, whether it is an inflationary play or disinflationary play, doesn't matter. We have people who bought homes with their blindfolds on, virtually, by the way. They didn't even see the home, and they paid cash for it above the asking price. Peak stupidity. They move into the home and they find out that the house is infected with mice and roaches, etc., etc. They have to call Rollins. It's a pesticide company. They clean up all these homes from infestations, and the stock has been a great outperformer year to date. What about the underperformers for the week? The notable ones. We have the ticker DE for Deer crashing by over 8.5%, almost 8.5%, also on the heels of earnings. Another one, the ticker FCX for Freeport McMoran, a stock that I own in my portfolio, crashing by about 14% this week. We talked about hedging strategies a few weeks ago, and I told you exactly how to protect yourself if you have shares of FCX. So this drop did not do anything to me because I'm perfectly hedged for this name. But the performance of FCX is a reflection of what's going on regarding the sentiment in the market these days. Number one, the dollar is surging higher. Number two, China, the biggest consumer of copper, all of a sudden shutting down due to the rise of Delta cases. And therefore, you're seeing FCX catching a double whammy here, and it is trading in a world of pain. Moving on to the charts, let's see what's going on here. I will start with a little market history for you regarding the cycles of the market. And by the way, I can show you in another video how to spot the breakdown, the end of the trend versus false breakdowns. But for the purposes of this video, I will keep it short and sweet because we're already out of time. We have the 1990s bubble, followed by the 2002 bear market. This is the SPX, by the way, the S&P 500, the cash index. Yes, we had a bear market, believe it or not, back in 2002, followed by the housing bubble that lasted from about 2004 all the way to the crash of 2008-2009. The famous double top, the crash right away, and we were heading into depression. The Fed intervened in the market by starting QE, and right away the problem went away and the market resumed rallying impulsively higher. Fast forward to 2015, when Janet Yellen, aka the godmother, decided to raise interest rates. When the godmother decided to raise interest rates, the market had some choppy trading because it has been dependent on the Fed's so-called accommodation, and the Fed started to remove that accommodation. And here comes to the rescue President Donald Trump with the tax relief rally. He gives Wall Street the biggest tax cut in many years. The market likes it, and it continues to rally higher and higher and higher, impulsively so. And then, in 2018, we got to a point where wages started to rise higher. Inflation scares started to arise, and the market had choppy trading in 18. Fast forward to September of 2018, when the Fed announced its so-called autopilot policy. This is Jerome Powell, by the way. Fresh new face. Not actually new, but new as in Fed chairman. The market crashes right away. Why? Because the market is a coke addict. If Powell says we're going to have an autopilot policy of raising rates and normalizing the monetary policy, the addict market says, hey, Fed, you're going to cut the coke, I'm going to suffer a withdrawal. And indeed, the market crashes right away, instantly. The Fed backs off and the market recovers instantly, right away. Then we head to the trade war, the choppiness for a few months there. Of course, Trump was bluffing. He was more bark than bite, and China knew that all along. And Trump, of course, backed off. No more trade war. Surrender right away. And the market rallies higher. And we started to revisit the inflation scare, the rise of wages, etc., etc. Comes to the rescue the COVID-19 crash, and that ushered a new era of quantitative easing, aka Coke, on steroids being injected into the market. And we have the largest bubble, the largest orgy in history, as you can see. Now, every cycle has a beginning and an end. it doesn't go on and on and on for infinity and beyond. And the question is, when will we hit the end of this cycle? Here's a chart for the SPY that goes all the way back to the 2009 bottom. This is the longest bull market in history, keep in mind, but it was still a healthy trend. For once in a while, we go back and revisit the trend line, meaning we have corrections. This coked up market since the March bottom of last year did not even bother going back and retesting the trend line at all. And the reason is it has been artificially pumped by the Fed and the retail mania. At some point, the assumption is the chart will have to go down and retest the same trend line. So when you have market bears predicting a crash of 20-30%, it's not crazy at all, because looking at the chart, it is inevitable that the chart at some point will go down and revisit the same trend line. When will that happen? Who knows? And therefore, calling tops is a dangerous game, but you have to look for indicators ahead of time, similarities, parallels to act as indicators to shift from risk on to risk off. And when that happens, the chart will go down and flush right away. Could it be a one shot? Yes, it could. And the reason is we have a lot of margin calls, we have a lot of retail participation in the market. And when that happens, we see severe crashes, the likes that we have seen in the 2000 dot-com bubble bust. Now, let's go on and cover the usual charts, starting with the 30 minutes chart of the SPY. Any problem here? Not at all. It is choppy trading. The market is trading above the consolidation box. Is this bullish or is this bearish? The answer is it is bullish. The bulls have the upper hand in this chart. It's trading at all-time highs, almost, trading above the last support line of 443. It managed to break above the consolidation box. It went down, retested the bottom of the consolidation box, and managed to pop higher above it once again. This is bullish behavior, folks. You cannot look at it any other way. However, when we zoom out to the daily chart of the continuous contract, as expected, as I told you, we will see a bounce off the trend line. And the bounce happened, and it was followed up by a confirmation on Friday. Now, we had the unique circumstance of options expiration on Friday, and the psychology had an enormous role in playing the direction in the market on Friday. We saw a lot of short covering, we saw a lot of puts being exercised, buying of these underlying stocks, and therefore the market pops higher. The assumption is that the trend will remain intact in the SPY until and unless the trend is broken. So far, we don't have this signal yet. Can you spot some weakness? Yes, you could. From the RSI, the MACD indicators, still in negative divergence. But looking at the chart, it is still trading above 4,384.5, and it is maintaining the trend line. Wait until the chart breaks the trend line, breaks the support of 4,384.5, and then you have a confirmation of the reversal and the weakness. What about the Qs? 30 minutes chart. What's going on here? Again, zigzagging back and forth within a range. All-time highs and the support of 360.5. Is there anything to see here that is bearish in this chart? The answer is not really. The look of the chart suggests that this is a consolidation range, and the assumption is that the Qs will break out higher. Now, when we switch to the daily chart of the continuous contract, we see some weakness. The candlestick pattern remains in consolidation range. It is trading above 15,000. All of this is bullish. Yet the momentum indicators, the MACD and the RSI, remain in negative divergence, indicating that this consolidation is lacking momentum. The destiny of this chart will be based upon the market's interpretation of the cancellation of Jackson Hole and the rise in Delta cases. If the market reads the situation as delaying tapering will not happen, oh, and by the way, inflation expectations will go down, then this will be a good environment for the Nasdaq to rise higher. What about the IWM 30 minutes chart? What's going on here? Bouncing off the support I indicated for you in the last video, 212. The IWM bouncing higher. It is in no man's land right now. It is trading within range, the support of 212 and the resistance of 218. Just like we talked about the Nasdaq, the destination of this chart is dependent on the market's interpretation of the cancellation of Jackson Hole and the ramifications of that on tapering and the outlook for inflation. If inflation expectations go down and the consumer, as I showed you, starts spending less on retail businesses, restaurants, hotels, casinos, gyms, etc., then we will see massive weakness in the IWM. Remember, the Russell 2000 was rising higher right off the November elections, and the reason is in expectations that the vaccinations will allow us to go back to normal. We will see spending, this pent-up demand on retail businesses, cruises, casinos, restaurants, etc. What happens when we get to a point where we have to face the music? That the virus is still here with us. Oh, and by the way, the vaccines are losing efficacy and we're back at square one. Not a good environment for the IWM. But perhaps this is the most important chart to watch. The Dixie, the US dollar. It has been surging higher in anticipation of tapering. Well, now Jackson Hole is canceled. We have Kaplan flip-flopping and saying perhaps he's not going to support tapering as early as October. If that is the case, the Dixie has been rallying in anticipation of tapering. You take tapering off the table, the Dixie goes down. This is the assumption. So we will see how the Dixie trades. But breaching 93 as support will be the signal that the market is saying we're not going to see tapering this year. Tapering will be delayed all the way till next year, 2022. What would that mean for gold? It means that gold perhaps will rise higher. If the Dixie backs off and let's say we see a scare in the market where yields go down, this will be a great tailwind for gold to pop higher. What about yields? What's going on here? This remains the mystery. How would yields react to the cancellation of Jackson Hole and perhaps delaying tapering? How would yields react to the fact that the American consumer is changing their behavior once again back to defensive mode, a la last year, in lockdown mode? Because defying logic, yields have been trading down as inflation expectations were rising higher and the pace of recovery on face value was going on as expected, on track. But the moment the Fed started talking about tapering back in May, we saw yields taking a 180 and trending down. There is a rule in the market that says always trust the bond market. The bond market doesn't lie. And if we trust the bond market, then the bond market was predicting this all along. The bond market was saying, watch out here. The virus crisis is not over yet. It will dampen inflation expectations and it will dampen the pace of economic recovery. Okay, the mystery is, if tapering is off the table now, will yields continue to drop down or will we see the opposite reaction of yields popping higher? Perhaps the psychological impact that the Fed is backing off, and perhaps Delta is not going to be that much of a problem in the long term, and yields start to pop higher again. We'll see. You gotta watch this one extremely carefully. The threshold remains 1.28%, but most importantly, the descending slope line of resistance. If that one is broken, then we have a confirmation that yields will trend higher from this point on. TLT weekly chart, what's going on here? This is bond prices, by the way, closing above 149 and trending higher. There is still plenty of room to go here from the momentum indicators perspective for the TLT to rise higher. It will all depend on the bond market's interpretation of the cancellation of Jackson Hole and perhaps delaying tapering. VIX, what's going on here? 4 hours chart. We talked about the pop in the MACD indicator that resulted in a 60% rise in the VIX. Well, now we have a confirmation that the pop is perhaps over. We have a crossing in the MACD indicator, creating red impressions in the histogram. Could this be a trap? It could be. We've seen it before. But for now, we don't play this game. Oh, it's a trap. It's not a trap. You read the information right in front of you as is. And the information right here says that the pop in the VIX is over. So the assumption is SPY rises higher. What about Apple? What's going on here? This is a 45 minutes chart. Illustrate for you the range, the trading range. 145 as support, 150 as resistance. We don't have a breakout one way or the other. This is, for me, the leading indicator, by the way. If Apple breaks above 150, this will be an indicator, for me at least, to go along the cues, specifically the big cap technology names. In this case, Apple, Microsoft, Google, Facebook. But remember, I sold my Microsoft. So if this happens, I will ride the ride via ETFs. Perhaps buying the Qs or buying calls on the XLK. We'll talk when that happens. But if Apple breaks to the downside, breaching the support of 145, this will be a leading indicator of a general weakness in the market, but specifically in the Qs. Tesla, what's going on here? 30 minutes chart. We're seeing bear flag after bear flag after bear flag. What's going on? The chart pops higher on so-called AI day, which was absolutely bizarre. Reverend Elon did not even talk about competition or the state of the chip shortage and the impact on Tesla's production. None of that. He actually revealed a new robot. I mean, the guy is way out of whack. He's living in a totally different world, isolated from reality. He wants to go to the moon. He wants to go to Mars. You know what the temperature is in Mars, Reverend Elon? You want us to go over there and colonize Mars? You first. So the market pops higher here. In the case of Tesla's stock in the morning, but we see profit taking right away. And we have now yet another bear flag formation. But I will give the bulls some credit here because the chart closed the week above 679. In addition, we have a formation of a higher low. So it is a battlefield for now between bulls and bears. And you can see it in the options volume, by the way. It is pretty much every single day, 50-50 between calls and puts. Perhaps the institutionals, the likes of Michael Berry and others, they're betting against Tesla and buying puts. On the other hand, we have retail participation. Perhaps they're buying a lot of calls on the prospects of AI Day or Reverend Elon is cool or Doge to the moon, whatever it is. It's a battlefield between bulls and bears. Bulls happen to be mostly retail. Bears happen to be mostly institutionals. Now, I do have puts on the name, a small position. We'll see if I'm going to add to it or not. It all depends on the battle of 679. If we have yet another rejection from 679, this will be a strong indicator that Tesla will go down to 629 minimum. So watch out for 679. BTC, tulips, what's going on here? Completing the ABC pattern and reaching the destination of 50,000. Almost. What do you do now? Obviously, BTC has a lot of momentum behind it. Since the bottom, we have a surge of about 70% gains in a short amount of time. Yet we have a topping formation in the RSI and the MACD indicators. What this means is, it doesn't mean that BTC will stop right here, by the way, but it means that the best of the gains is behind us, and you should be a seller here, not a buyer. Perhaps wait for the retest of 42,000 before hopping on the ride once again. And perhaps the leading indicator here is ETH Ethereum, which I bought on the double bottom, by the way, but I got out early at around 2,500, and I told you back then, it could go a lot higher. But for me, 2,500 is good enough. In, out, hello, goodbye. What do you know? ETH goes higher to around 3,000. But now, unlike BTC, we're seeing a negative divergence in the RSI and a negative divergence in the MACD indicator. And unlike BTC, ETH has been consolidating within a range, indicating that perhaps the weakness is more evident in ETH than it is in BTC. Which one is the right leading indicator? Is it ETH suggesting that BTC will go down, or is it BTC suggesting that there is more juice to the rally here, and perhaps we will see another final pop in ETH? Lastly, what about AMC? What's going on here? Daily chart. Once again, the apes defending 32. The apes understand that once 32 is breached, the floodgates will open. Wide open. We will see a crash in this stock. They understand that every time the stock goes to 32, you got to show up and buy and defend 32 to death. And this week was yet another attempt to break below 32, but the apes showed up once again and defended 32. So where do we go from here? Look at the MACD indicator on the daily chart, by the way. The MACD says that we should see a pop in AMC. We should see a rally in AMC. Whether it is a small rally, a big rally, the MACD is opening the gates for a potential of a rally. It depends on the apes and their allies whether this will be a big rally, a small rally, or just consolidation here. The worst case scenario is the chart consolidates for a little while. And the reason is, while the daily MACD is indicating that AMC has the potential of popping higher, the weekly MACD on the weekly chart, which is the more important and more relevant chart, has already topped and it is trading negative. So in the short term, there is a potential for a pop. But on the weekly, the long-term chart, the break below 32 is inevitable. What I'm trying to say here The apes better pop AMC higher, impulsively higher, while they still have the window to do so. Traded above 40, 45, 50, and then you have some repair on the weekly chart. But if you just consolidate here between 32, 35, it's a bad signal indicating that the weekly chart will take course and the stock will crash below 32. Moving on to the conclusion of this video, what do we have on the economic calendar this week? On Monday, we have the manufacturing and the services PMIs. Now, this will be less relevant this time around, and the reason is it is a lagging indicator because we have the Fed canceling Jackson Hole, and we have a Delta scare, a mini one at least for now. So even if these numbers from the manufacturing and services PMI come out hot, the market will take them with a grain of salt. And the reason is the market is concentrating on why did the Fed cancel Jackson Hole? Does that mean that the economy is slowing down, inflation expectations will go down, perhaps peaking, and that will lead to the delay of tapering? We also have existing home sales. This will be important for the housing market and lumber prices. On Tuesday, we have new home sales. Perhaps this is even more important than existing home sales because the expectations are that existing home sales will accelerate as homeowners realize that the party is about to be over. What about Wednesday, August 25th? We have durable goods, again, an important inflation indicator, but the market will not pay attention to this one as the market is extremely laser focused on the Jackson Hole meeting cancellation and the potential of delaying tapering and perhaps more economic ramifications from the rise in Delta cases. Thursday, we have, per usual, the initial jobless claims. These will be extremely important. And the reason is, I showed you in the intro of this video that the consumer is changing their behavior in a negative fashion. Will they follow that up by claiming unemployment? And if that is the case, then the Fed will have a massive orgasm because the Fed will say, you see, we were justified to shift the concentration from inflation data to employment data before we start tapering, because here we go, we have more unemployment claims now. But perhaps the most important day from a macro perspective will be Friday. We have personal income, consumer spending, core PCE. This is what the Fed looks at. Then we have the University of Michigan consumer sentiment. This will be the final reading, and it will be extremely closely watched. Why? Because in the preliminary reading, we had a massive shock, a historic drop in consumer sentiment. Will it be confirmed and verified by the final reading, or will it be negated? This is what we will be watching for this week. Anyhow, folks, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.